Welcome to session 5. Yes.
All right.
Today is November the 12th. We've been meeting for 5 weeks. I have to remember there's another meeting going on. Excuse me, Jeff. Welcome. Welcome. In the letter that we sent you to begin with, we said, learn top 5 facts you must know to successfully sell your business. Number 1, there are many ways to value a business. Do you know what your business is worth? Number 2, is your business at the peak of its value? Number 3, does selling to a family member or employee make sense? Who values your business most and why? And are you considering your tax liability in the transfer of your business? And the 5th is, what are the risks now and how could you minimize the risks in a business sale? Michelle, I'm going to ask you if you'll read the first 2 from this, and then Rich, maybe you could read the last 3, and then we can see how we're doing with this project.
And this is on session 5?
Yeah.
Okay.
Well, here, why don't you read the first 2 sessions. In other words, we're doing a little review.
Oh, okay.
This is session 5.
Okay, so on session 1, course introduction, we had discover why exit planning is mission critical and why you need to begin now, even if you plan to stay in the business for many years to come. Assess your current circumstances and determine how prepared you are for the unexpected. Begin crafting your own smart exit strategic plan. On session 2, risk and estate planning, we went through identifying the major risks you face now and in the future, incorporate risk factors into your strategic plan, learn about estate planning and how important it is to your exit plan, and also advance your smart exit plan with attention to risk and estate planning.
Great. Is that 1 and 2? Is that sessions
That's
1
1
and
and 2.
1 and 2? Great. Rich, would you read 3 and 4?
3 and 4?
Yes. You might as well read 5 as long as you're at it. And you can skip the last line of it, how it incorporates into your strategic plan.
Okay. Session 3, employees and operations. Assess your current employee strategy and identify short and long-term goals to maximize your human capital. Learn about standardizing operations and identify specific ways you can improve processes without a big investment of time. Advance your smart exit strategy plan with attention to employees and operations. Session 4, financials. Learn how to use financials to steer your business. Discover the power of cash flow projections to gradually replace your presence in daily operations. Advance your smart exit strategic plan with attention to financials and cash flow. Session 5, evaluation and your next steps. Learn how to determine the value of your business. Discover why some businesses lose value through small business discounts. Begin the process of evaluation for your business. Advance your smart exit plan with attention to evaluation. Determine your next steps.
Thank you. Thank you. So, in those first 4 sessions, we did a series of questions that have gone to building your document. And in the first, we looked at the history, your current circumstances, the opportunity, the growth in revenue and net profit, operations, self-managing, succession planning, strategic plan items, exit date, updated value, and future value. And then we went on in our next session to company strengths, weaknesses, opportunities, threats, using strengths to seize opportunities and trends that could benefit or threaten. And then we went into planning with the end in mind, keys to building value, customer value proposition, why employees continue to work for you, training new and veteran staff, employees who've recently departed with some whys, what your firm does best, and market trends in your first asset list. And in session, the second half of that session, we looked at risk, and how to mitigate those risks with what is your company insurance, what keeps you awake at night, what risks would you like to cover, and your key person insurance. We looked at estate planning with the business entity choices, the transition options, multiple ventures, and forming a trust. And then in The last session, last week, we looked at people and operations, and we looked at the systems model, the best employees, and aligning people and systems. Do you have any questions at this point of what the last 4 weeks that you'd like to go over or discuss? And there was actually another piece I'm forgetting about the financials and steering, and we'll get more into that. So at this point, without any further questions, I'm going to welcome and introduce Miss Janice Forbes. Janice,
Thank you.
Janice. Thank you very much.
Thank you. Good morning. So do we just
Yep, just right.
click away?
Yes. Did you put any special things in the presentation?
No.
Okay, No, like little animations
No
and all that kind of
transitions or
all those funny.
animations.
Yes. Okay. Good.
So,
Good. I was a
all
little
right,
worried.
good morning. I have the opportunity to talk about innovation this morning, and it's an exciting topic. I talked a little bit about my background week before last when I presented on best employees. And so I won't go through the whole thing again, but suffice it to say that my 25 years in corporate America were with small and growing companies. And one company, the telecommunications, the national telecommunications company, Metro One Telecommunications to be exact, I was in charge of training and customer care. Our clients, Sprint, Nextel, AT&T, so some big ticket names. And when I joined the company, we had 500 employees and 9 call centers. And 8 years later, we had 7,200 employees and 32 call centers across the country. And I grew my team from 2 people. When I came in, they had no training, no quality control. All the operators were kind of just like, oh, you know, when I talked about training last week, the operators come in, another operator says, this is the way we do it. And of course, there were lots of quality programs. So we standardized the training programs and put a quality assurance program in and built that training and quality control program to 100 employees over that 8-year period. So the company recognized that training and quality was the key to success in operator interaction with the customers. But how do you go from 500 employees to 7,200 employees in 8 years? I mean, that's like strap on your seatbelt, folks. We're going for a ride, and it was like that. But there's a balance between this is the way we do things, and we need your ideas because we're going fast. And so that's what I want to talk about today in innovation. I have some ideas to share with you, and some other things. So innovation. I found this definition, and I thought for the purpose of entrepreneurial group here that this was very good. So innovation is something different that has impact. Different shows how innovation involves a new way to solve an old problem. And impact is that until you have delivered increased revenue or profits, improved the performance of a process, or materially improved someone's life, you haven't innovated. So there has to be some bottom line results. It doesn't necessarily need to be the profit line, but there needs to be some bottom line results in something. Innovation can be incremental or transformational. So we might have an idea that's an innovation to the company and the way we do things or the way we present our product, and we incrementally make those changes, just like a cell phone has new versions that come out. Well, the software updates are incremental innovations or changes, and then a brand new phone is transformational. So we need to find the balance. And my example of Metro One Telecommunications with that fast growth was, how do we put in standardized processes, programs, procedures, and products versus the ability to quickly make changes? And so that's what the main focus of this small talk will be. But I'd like to ask our participants and everyone in the room, what are some of the ways you, your company, your team have innovated in the past. Anybody? Yes?
There was a gentleman that, he had all the projects and all the processes down in his head, and he would keep having to tell us over and over again, so I went and videotaped and used that tape to create 4 different processes in documents and mind maps and stuff like that, so we wouldn't have to keep bothering him, and the team could move forward.
That's an excellent example of a problem that's causing problems and an innovative idea to eliminate that altogether. Anybody else?
The use of computers and digital formats that have dramatic effect on companies.
Oh, absolutely, and especially in the industry that you're in, for all those years, you probably started out with pencil and paper.
Yeah, I have those.
Yeah.
I still have some of those ledger cards that we made pencil entries on. And
Yeah. Well, my very first job was at Miramar Naval Air Station typing chits on a computer for problems on the military base. Not a computer, a typewriter in triplicate. So yeah, that has been something that we always have to innovate for or be willing to change and accept. But the way you do that can mean the difference between winning and failing, succeeding and failing in the implementation of computer technology. John, did you have?
One of our clients is very comfortable, and everybody in the company has been there for many years pretty much, and everyone knows what everyone's job is, but they're about to be hiring new accountants because 2 of the accountants are retiring. So they need to put in writing the job descriptions and the policies and how work flows from one to another, just so that they can train the new people and evaluate the new people. But they're scratching their head saying, golly, do we really need to do this? Because we all know. And we'll just tell them. But then they know, really, that that's not the best way, because even though they can verbally train them, it's very difficult to evaluate that employee when you've told them they're doing the job, but they're missing a part. You can correct them, but then you have to do that with every single employee over and over again. So it becomes a real obstacle when you have new staff in particular.
Absolutely, and the process, developing the process to bring the new hires in, so there's a realization that, hey, we know how to do it, but perhaps we can do it a little better by having standardized processes, programs, and products, i.e. our hiring method. But once you get these in place, how do you keep them fresh and updated without becoming a large, like a large corporation where it takes forever to get anything done, or like a very, very small business who doesn't have any of these and kind of flies by the seat of their pants all the time. So that's our conversation today. Anybody else? Rich?
We implemented lean manufacturing on our production floor and Six Sigma
Nice.
standardization.
And the decision to do that came from, what brought your company to that decision?
Just noticing waste and areas for improvement and to drive to cut costs,
Yeah.
standardize the floor.
And how was the outcome? How's the outcome been?
Good. I guess one thing that we learned out of it was that we were pretty lean to begin with. Wasn't a huge transformation, but it still kind of put everybody in the right mindset to work effectively, efficiently.
Awesome.
It helped.
And Michelle, I know you're getting a new machine, or maybe.
Hopefully, it's,
Hopefully, if it shows up. But
yeah,
that's
we'll
one way to innovate there, is
Yeah.
to upgrade
We're
your.
just waiting. If we ever get it.
Thank you for everyone who shared. So I'd like to go over some guidelines for innovation and, how do we develop a culture of innovation? What are the pieces that makes innovation something that's accepted and acted upon in the organization? So it starts with the individual. Without the individual, there's, nobody's gonna come up with a new idea. It starts with somebody saying, this is the way we do things, wow, I think we should change it due to a problem, a broken process, a product with complaints, or
New
I'm sorry.
technology.
new technology, thank you. All right, so the company and everything else is fine, and we want to keep our cogs going, but the individual is where innovation begins. The next step in innovation is the team. So an individual can have a great idea, but you need a variety of skill sets in order to execute the innovative idea, or the idea. And so the team becomes very important. The third factor for innovation is the enterprise, the company. Is there a culture that allows, encourages, and rewards new ideas? And so as we go through the next 4 through 10, I would like to say that keep these in mind, because without an individual who has the autonomy and the feeling like it's okay to have a new idea, without the team to execute that new idea, and without the culture, then these things really don't apply. So that's the foundation. Processes. So processes, and I'm going to talk a little bit more on the next slide, and I don't want to go over, so John, if you could keep track of what I'm doing right now. So the processes that drive innovation can be something like a structured brainstorming or other creative process that the company says, okay, we support new ideas, we support innovation, and we want to do it in this process. So that gives everybody a nice guidelines to work in while still being able to think outside of the box. So that's one thing an enterprise can have are those creative processes. What are our offerings? So lots of times we might think that my product is great and let's innovate with a new product, but we have to keep in mind all of the things that go around launching that product. I mean, manufacturing, marketing, marketing and sales. The physiological climate is there enough autonomy or caring for the individual in the company about their emotional intelligence, about their well-being? 4 minutes, oh, I better hurry up. Okay, about their well-being and to feel comfortable enough to have ideas. The physical environment. Okay, there's a lot going on in corporate America about the physical environment today. I have a friend who works in an office he's always been at an executive level, senior vice president and or above, and now he's working in an environment where there are no offices, no cubicles, no anything, and they have workstations where you can stand up or sit down or anything. And so people are constantly working to create the right physical environment. You look at Santa Clara, Silicon Valley, and the ways that they try to create an environment for innovation. Then the organizational culture, which I've spoke about before, but what do we do to reward employees that have great ideas? And I think, Rich, you have something like that already in your company that rewards employees for new ideas. And I know at Wilco, when I worked at Wilco, we had a place where people could submit their ideas on a standardized form. That would be reviewed by the executive team, and if that idea was implemented, there would be a reward of cold hard cash. So people knew that they could come to the executive team and have their ideas heard. And then economic conditions play a role. So here's, with employees, if you say, we're on top of our game, there's a risk of complacency. And if you say, everybody's getting laid off, or this whole department's getting laid off, there's the risk of being demotivated, apathy comes. So it's a real balance in keeping this environment of creative movement forward in how you talk to your employees. And finally, the geopolitical culture. Instead of just accepting that, you might want to look at our culture and how you can capitalize on the way that our culture plays into the way your employees do their work or the messages they're receiving on a global basis. This is a method for innovation. This is something that I've used in companies and projects before that works very well, and I would walk into a company tomorrow and say, this is a really good way to create your processes and have them be in a cycle of continuous growth. And that starts with, and I don't have a lot of time to go through this. So anyway, you get a subject matter expert team, you develop the process, the idea, the program, you test and finalize it. So this group works a little bit. You review and approve with the senior management, you get there, you launch, you measure results, you modify, and then you put it on a calendar to modify in the future. Anybody would like more information about that, I'm happy to share after the class. And continuous improvement, we want to be Zazen or Kaizen, continuous improvement from Toyota. What you want to do is identify, prioritize processes and programs. So list them all out. What do we have? What do we need as far as processes and programs? Maybe we have training, but we need it to be better. Maybe we have no training. Maybe our AR process, we have one, but it doesn't work that well, and we're not getting the money in as quickly as we need to. You establish a method, develop, review, upgrade, publish a schedule as to what we're going to be working on in the future. And then consistent implementations. You want to measure your results of your launch and do it as consistently as possible.
Janice, we're going to go another couple of minutes to give you another few minutes.
So I can breathe? Okay.
We got started a few minutes later.
Yeah.
Go right ahead.
Okay. I'd like to talk a little bit about validated learning. And this is from the Lean Startup that John likes to refer to and utilize in consulting. And it's a great way to move forward with little risk. So when you hear the term minimum viable products, or MVPs, in product development, or let's say website marketing, or virtual marketing, online marketing, you can do something that will not put, you don't have to invest a lot of money, but you want to choose the things that might have the highest return. So as an example, if you're doing a website, let's say you have a website and you sell widgets on the website, and you want to sell widgets or something. So you can test like 2 launching pages or 2 shopping carts, or 2, and so you can see what comes in and measure results and then use the one that works. You say, wow, this testing method we've developed, this A/B testing method, we like it, let's use it on something a little bigger. So it's like putting your toe in the swimming pool and then going up deeper and deeper until you're really confident that you have a good testing method in place. You're always testing new things, and you want to make sure to measure your results. So I'd like you to think about what is your next testable minimum viable product. And so that I'm clear, it could be a process in the company, something in accounting or operations or HR even, or training, but I always go back to training. And then, or it can be something to do with your product. Michelle, I know you're working on your website, so putting in a shopping cart and seeing how to seeing what works to drive traffic. Is it an email campaign, or is it advertising on Facebook, or is it trying to go free on LinkedIn, or use free, less expensive things. And that is all I have. But I have an article for our I can certainly print more, but this is a reference to the things that I covered in our talk today.
Well done.
Oh, thank you.
And now I'd like to introduce Mr. Bob Chase. Bob Chase is a CPA, and he's a valuation expert, and he's going to be talking about how to value your company. Bob, thank you for joining us.
Thank you, John. It's my pleasure to be here today to talk about business valuations. It's something that is close to my heart, something I've done for a while, and it's very interesting to me. When I go out and do business valuations or value a company, I take a hard look at what the company is, and I try to get inside of it. How's it work? What's it doing? Is it doing great? Is it doing not so great? All those things are factors in arriving at a valuation. And we talk about valuations. Which key do I punch?
The right,
The down.
oh, down.
Here.
One more.
That's okay for now. Okay. And so when you talk about valuations, it's a very difficult topic to talk about because there are different values for a company. There's a market value. There's an intrinsic value. There's a value that a company just will put on your business just to acquire it. And then there's fair market value. And depending upon the circumstances you're faced with, you could use one or the other or your own method. So when we're talking about exit strategies, we're really talking about the important thing, what you will receive from the eventual sale of your business. And so that is the fair market value. And when we arrive at fair market value, we use different approaches to do that. There's an asset approach, a market approach, an income approach, and there is a rule of thumb. The asset approach is really not a too good approach for a company that is an active company, producing a product, offering a service, or something like that, because the assets really are grouped together, including the goodwill, and it all fits together as one big package that you want to sell. You use the asset valuation approach when you're maybe liquidating the company, or a company is not doing so well and there's no goodwill attached to it, and so you would use it in those circumstances. Another area that you would use an asset approach is a mutual fund. If you take a look at mutual funds, the only assets really in those funds are tradable securities. So every night, those analysts sit down and they value each one of those investments and arrive at a value for the whole company at the end of each day. So that's an asset approach for arriving at a value, not apropos to an operating company. Really don't need that. The next one is the market approach.
You've got a slide on that, if you go
Yes.
down a slide.
Okay, well, I'm not sure I want to get there, but okay. Okay, we talked about the asset method, whether the specific asset values you have to arrive at, and the advantages and disadvantages that you really have to value each asset, and you go through all that process, and you're not really sure that's what you could sell your business for anyway. So those are the disadvantages to the asset method in the operating company format. And a market approach is you have private company transactions that you could look at, and people put together databases filled full of companies, their sale price, what their sales were, what their net income was, so you could do a comparison of those. And there's a public company transaction, a guideline company, and those are the ones that are traded on the stock exchanges. And you can sort of compare, this company is in the same business I'm in, and that's what the multiple that they trade for is maybe what we could trade for. So that's a possibility. And then there's a merger and acquisition method where you take a look at companies that merge with large companies and the values that are attached to those mergers, and you could arrive at a value there. But in your circumstances, a small company is just really not something that's you can use. First of all, you have to buy a database, and that changes daily, and so that's not really going to be very convenient for you. And the public transactions, I'm not sure a publicly traded company is really the same as your company. And so I'm not sure you really get some, in the merger and acquisition method and the public company transactions method, I'm not sure you really get a good figure on the value of your company. So I'll go down. The income method is the one I really like. And that's predicated on the fact that your company is a going concern, and it's one that's operating, and one that's making money, and there's no visualization of stopping that. So the income approach is where you take the net income of the company, whether it's cash flows or whether it's net income, and you capitalize it based on how much a return of your investment you want each year, or somebody else could make. Okay, and so the income is determined by either the net income of the company, cash flows, or earnings before income tax and taxes, and earnings before interest, taxes, and depreciation and amortization. And also the capitalization rate, you would have to develop that capitalization rate in order to apply that to the net income that you choose. We're not ready for the rule of thumb part of it yet. But what we're talking about is, let's go back up. What we're talking about is the capitalization of net income. So if a company has, for example, $50,000 of net income or cash flow, and that's steady throughout the years, and your capital or your income expectation rate, the interest rate or return on your investment is, say, 20%, then you would have normally a value of $250,000 for that, for your company. And so that's simply the $50,000 net income with the rate of return divided into that to come to the $250,000. So if you took that money to the bank, the $250,000, and put it in a CD, you would earn virtually nothing, very, very little, because your investment's safe, you'll get it back anytime you want. And so if you go to the stock market or go to treasury bonds, your return is still very little, you don't get much out of it, you get 1.2%, if that, you know, and so but that's a very safe investment. You'll get that money back. If you go into an equity like Procter & Gamble, for example, that's a little bit more risky. So you have maybe a premium that you would pay on that, because instead of 1.2%, you might get 4.5% based on whatever the company's stock is selling for and what dividends they pay. And so the interest rate is, the cost of capital is going up. And so